All right, well, we're going to wrap up 2019 with tonight's video on Market Outlook video. We're going to be off tomorrow for Christmas Eve and the rest of the week as we normally take here at Market Scholars. Brandon and I normally take the week off between Christmas and New Year's, which means our next Market Outlook video will be January the 2nd, next Thursday, after the New Year holiday. So keep that in mind. That will also be our next Market Outlook live video for those of you who are Plus or Premium subscribers that have access to that. We'll go over our trades as always. Again, if there happens to be any significant or major moves, which is highly unlikely, but if there is, then I'll pop on and do a Market Outlook video probably after Christmas if there is one. But I highly doubt. Unlike last year, the market's in a very low volatility grind right now, which means when we're in the holidays, expect very low volume days and nothing moves, and we can spend that time with our family and friends and enjoy the holidays. So before that happens, we'll finish up and kind of look at what kind of markets we have going into 2020, and then we'll take our trade idea of a stock that has had a lot of pricing in as some good news over the last little bit that might be finally taking a breather. So let's go ahead and get started. Today is Monday, December the 23rd, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see we've third up day in a row here on SPX, coming off 1, 2, 3, 4, 5, 6, 7, 8 out of 9 days to the upside. That all 9 of those days, let's see, this would be 8 of those days, has the near-term line up above 50. So remember, the typical near-term run of the blue line getting above 50 before coming back down is 7 to 12 days. So we're in the middle of a normal run. Coming off of an overbought cluster with the intermediate line still easily above 80 and market sentiment easily above 80, which means we got a strong bullish trend. It's not going to significantly fall anytime soon. If anything, the near-term line will drop below 50. And we'll get a pullback towards that 30-day moving average, but that's about it. The momentum line fell, but not to oversold levels, not to extreme oversold levels that would suggest that we might get any kind of near-term or any kind of trend reversal. So the trend still goes, and as quiet as today was, we closed up on the Dow Jones Industrial Average despite the down day for Boeing, or at least the up day, despite the recent weakness for Boeing. The Dow continues to show a strong bullish trend, strong long-term posture with that with the market sentiment. Now this is a little different. The Dow's been a little different because of all the long upper shadows. Well, this wasn't a long upper shadow, but we opened up a lot higher than where we closed the day on Friday. And so with all that being said, it's kept its near-term line from getting above 80. Even though it's been up 8 days, just like the S&P, it hasn't gotten to above the 80th percentile. So little sign of weakness there, as much as you can consider it to be one. The NASDAQ Composite and the Russell 2000 are very strongly bullish, and they continue their trends to the upside. So, and with minimal drop declines in their momentum line. So you can see that the trend continues to be bullish for stocks in general, going into a new weekly candle on the S&P. Obviously, we have a very small range, and that's what's brought the momentum line down. Depending upon where we close, that will bring that momentum line back up if we get any kind of range. Otherwise, if this week's range goes to the downside, it will keep the momentum line down. But that's okay. I mean, you can see we're on a near-term run right now on the weekly chart, that we're just maintaining this trend. So, obviously the path of least resistance is to the upside for equities. Now, we've had strong trends like this before, and they've continued higher after having achieved these levels before. So, as we saw even earlier this year, obviously coming off a much deeper low point. In fact, all the other times really that we've had significant declines like this, really that this was very similar in 2017 because of the tax reform. We weren't coming off of significant bearish lows. Each bearish low point got progressively weaker this year. We had talked about that before on when we had that third pullback, that they were getting progressively weaker. In 2017, we didn't even get those dips before we had this run. And we were coming off of the election low point here where we had a brief little bearish turn similar to what we had. And then you go back to other times where we've been strongly bullish like this in 2006. Going into the end of 2006, we had a really strong run. We were coming off of a pretty significant low there, and we hit strong trending levels that stayed for a long time, for weeks, for a few months. So a very similar type of pattern developing here on the S&P, and of course from a Bollinger Band standpoint, we're trading along the upper half, very high in the upper half of the range, close to the 100% level. But you can also see too how we're pulling away from the value area, and the more we pull away from the value area, the easier it is. The easier it is for there to be a decline. As long as there's a catalyst, right? As lacking a catalyst, we just kind of grind our way. We maintain this trend and grind our way to the upside, and that seems to be the pattern right now. Coming off of a 4% decline, any kind of pullback we get would be similar to what we've seen before. Just maybe a 1 to 2% pullback is all I really expect. That would actually get us down into this area, and that would literally be it. And most likely spark a new 3 to 4 or 5% rally coming off of that, as we've seen in previous trends similar to the one we're on right now. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video that notifies you when these videos are posted. We hit the 5,000 mark. We're continuing to grow above that level. We really appreciate that. Hit the thumbs up icon that's down below the video too. That tells us two things. Number one, you liked our video today. Number two, you want us to do it again. It's our survey. It's a quick way for us to get feedback on what you think about our videos. If you like them, hit the thumbs up. If you don't have to click anything. Also, while you're down there, comment. What did you get out of our videos today? Join our Market Scholars community at marketscholars.com. There's a link posting up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. If you're watching on our site, we invite you to check out these other things that are on the site here. You can see we have our calendar of classes upcoming. We actually have a break in between the holidays, as that's something we take off every year. If you're interested in our classes, there's a monthly subscription plan. Our Plus plan gives you access to all 8 of our classes, and it gives you access to our Market Outlook Live, a highly requested feature that people have asked for, where we look at old Market Outlook trade ideas that we've posted, and we manage them all the way to the time that we get out of them, so that you can see what do we do. It's one thing to put on trades. Everybody tells you what trades to put on, but nobody really ever tells you when to get out and how to manage it going forward. So we do that with that live video that I do on every day that I do the Market Outlook videos. That's the link that gets there. We also invite you to engage with us on social media. Hit this little heart that opens up this window. You can like today's Market Outlook tweet. Hit this thumbs up. You can like today's Market Outlook Facebook post. Again, the more you engage with us on social media, the more those platforms will promote our content to the top of your timelines. They only promote the content in your timelines that you engage with, so we try to make that really easy for you. All right, let's come back to the charts, and you can see this week's candle that's just only a day old, right? And you're going to only have a half day tomorrow, and then no trading on Wednesday, of course. So you got about 2.5 more days left on the week. It's a pretty bullish candle, depending upon where we end up closing. The Hakinyashi closed at the last week's high is 32.25. We're at 32.25 right now. 32.27 is what we hit as a high on the regular week. Still very strong bullish trend above a rising 50-day moving average. It's got really strong momentum up where you can see, and you can see it's been up here before, so it's not like this is out of the realm or this is to a super extreme level. You see all the other times that we've maintained and continued for weeks to have even stronger trends than what we have right now. Again, you have to keep in mind here that this trend that we're currently on is, Here we go. Doesn't look as parabolic when you put it on this perspective, which is probably the perspective we should keep it on. As you can see, it looks strong. It looks as bullish as we were in these areas, but like I said, it can be more parabolic. This is not parabolic or euphoric in any sense when you take it off of the arithmetic scale and put it onto the log scale. Other times that we've been this bullish for this long, you can see we're in 2013-14, and of course in 2011, right before the credit downgrade, we were relatively bullish. And again, we're not even nearly as parabolic as we were there, where we came off that 2010 low for about 9 months and went straight up at that point. Let's take a look at the three green arrow chart here. Here we go. You can see we have continue to have 3 green arrows. We are losing some momentum on the MACD. But that's not surprising when you get this far above the 30-day. When you get this far above, like 30 and 17-day moving averages and 8-day. We've extended away from the 8, and I showed you that before last week, and now we're kind of slowing down, which is very, very normal for us to slow down when we pull away from the 8. In this case, slowing down with the 8-day moving average catching up to where we're at right now. So, but still way above the 30. So when I look at the actual MACD here and change it to look at how far above the 30-day moving average we are, here we go. Then you can see here we are relatively high. If I were to give myself some more time so you can see a context, this is about as high as we get, and it's about as high as the orange line gets. Again, we can slow down and start grinding our way back down towards the 30, but as it does that, we just stop going up as fast, similar to what we saw over here, where you just stop going up as fast and we kind of go sideways for a while before we converge. So that's the kind of move you expect to see, where now we're at these elevated levels, and we'll continue to grind our way higher as these lines that has diverged start to converge again. All right, if you take a look at the intraday chart, again, just how wide this range is. It's just under 5%. At 323, 324, that's where the 5% mark comes in to play with this 307 low point. We've got a few days, pretty much the rest of this week, into the rest of this year, that we have that as our low point. Then the low point's going to move up quickly again, as long as we kind of grind our way to the upside. That's going to change the dynamic of the volume profile. You can see where the different levels are, but the point of control remains right here. So, again, that's a good sign for us to be above the point of control, obviously. But it also shows how quickly we can get below that. And once you get below it, you can move to lower levels quickly. So keep in mind, though, you'll have areas here, and the bigger one being right around 314. That happens to also be the 4-week midpoint if we ever break that point of control and work our way again to the downside. Probably not going to happen the rest of this year. If we take a look at today's volume and today's trading range, the trading range was 0.6 points, very, very minimal. Volume down at 53 million, also really low. So when you put those numbers into context, very, very low range. Volume really low too, 53 million. These are really small numbers. The ATR being below this 1% level, it's entrenched. That's when you get below 1%, that's when you've got the bullish trend, on this intermediate run, and you're going, and that's where we're at. And it makes it hard for us to have any pullbacks, right? Because it takes bigger ranges and bigger volumes to get the types of pullbacks that you need, and you can see we're not anywhere close to getting those kind of levels, and probably won't for at least a week until the beginning of 2020. Finally, let's take a look at the volatility index. It's up a little bit here today, but still easily below 13, and easily in bullish and the oversold levels of bullish territory. So very strong bullish intraday moves and kind of peripheral moves here on the volatility index. So the trend stays. The trend stays strong, and and we are in small, slow, grinding mode with volatility as low as it is, and unable really to get going too much lower, but also not taking off either to the upside, especially when you look at the monthly range here so far this month is up 6.25 points. That's well more than it was in November, and not as big as the actual range is, but big enough to where we don't have to worry about the big spikes that could come out of nowhere. Those big spikes that come out of nowhere come when we're very oversold on volatility, and there's been compression to where the range is really, really tight itself. All right, so what do you think? Do you agree with that technical assessment? Do you disagree? There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up a poll. Then you can hit either agree or disagree. As always, if you click disagree, which I'm sure there are some out there, comment down below on why. What are you seeing that probably most likely for those who are disagreeing makes you a lot more bearish heading into 2020 than what I see right now. And like I said before, you might be thinking we're closer to the end of a long-term bullish move than we are the beginning, like we've talked about here before in previous videos. So let us know what drives your opinion, whether it's a technical indicator or economic indicator or whatever you see somewhere else. Share that with us down below in the comment section. All right, there wasn't very many moves. In fact, they're kind of off here on this chart. Everything else is pretty tight within 0.6 to the downside and 0.6 to the upside. Gold and crude oil being the big winners. Real estate and bonds, bond prices being the big losers. If you take a look at some of the major asset classes and their performances, including the dollar. Here, let's look at a daily chart for the dollar. Well, let's do it this way. Let's look at this chart and pull up the dollar index. Here we go to yesterday, and you can see it was a down day and appearing to hit some resistance here at the moving average. I think there's a good opportunity for us to roll back over after coming off an oversold level and continuing with this bearish trend where we've had dark pink shading and a red line. And we have light green shading right now, with dark green coming on today. The dollar index starts in the evening, so this candle here is just starting the Christmas Eve candle. And if you take a look, you remember the other big moves were crude oil and gold. This is the bounce in crude oil that we had. Again, this is the start of the candle that we're seeing for Christmas Eve. So a little bit of bounce there, and then you take a look at gold as well, and gold's had its own bounce up today post expiration, a little bit of a breakout type move. Again, don't read a lot into light volume holiday type session moves. Of course, TNX yields had a pretty decent bounce as well, and with the dollar dropping, that's actually a pretty decent sign for gold on one hand, but gold would lag behind other safety asset type classes, risk asset type classes, including equities, including commodities. Commodities are a laggard. They'll generally come up with yields as inflation expectations rise. Equities will also continue to move high. Remember, 2019 was a pretty risk-off move for equities and risk asset classes in general. Until here coming off this October low point is when we've really started to take off again, kind of the opposite of what we saw last year, going into a strong Q4 and then potentially moving into a good 2020. Once we see those commodity prices start to rally along with yields, then we know we might be towards the end of a bullish long-term run. And obviously we're not seeing that yet, and that would coincide with some weakness in the dollar that we're just now starting to see as well. Of course, when you look at all these the 12 grid for these different charts, you can see the bullish asset classes and the safeties. There's some issues here with those two ETFs, but you can see how long-term bonds and real estate are on relative declines compared to these different equity asset classes. High yield bonds doing very well, as well as yields in commodities, gold and crude oil more specifically, on bullish trends. And that's a good sign for the risk trade in general that's been sideways pretty much all year, especially in the Russell 2000, right, which which is well below its January, or excuse me, well below its August, September highs that we had. We are finally above those January highs. But look at the sideways trend we've had for most of this year. And of course, crude oil with a very similar pattern. So, there's those September, this is actually October high point here, the January high from over there. So very similar pattern. So we would expect a breakout of the 60% level, which would now make a run back above 65 and higher. That's it. That's the expectation, and will be another sign of growing risk appetite going into the new year. Looking at today's move, you can see energy, which was the worst performer for all of 2019, was actually the best performer today, and you have your interest rate sensitives. In fact, if we take a look at, let's take a look at this on a year-to-date basis here. Here we go. So pretty much all of 2019, you can see the worst performer has been energy, and up until this December low, here's that October low point that we've all started to bounce off of. Energy was actually negative for the year to date on that October low point. Equities were up 15% year to date. The S&P now finishing up closer to 30%. Look at technology up almost 50%. A lot of that's Apple. Right, you can see communication services making a run as well. Those are your FANG stocks. Financials had a good 2019. Industrials lagging. You compare that to how things turned out in 2018. If we come over here and compare that to the year before, energy was also the worst performer in 2018, was down 20%. Equities were down 6%, but before that we were almost up 10% with discretionary technology and healthcare leading the way before the sharp declines where we had energy, materials, and financials and industrials all struggling with the drop in yields and the drop and the trade war, struggling, keeping things down. You can see healthcare actually finished the year positive. You can also see too that consumer staples and utilities finished the year slightly positive, and technology finished down only 3%. So it was a down year, down 6% for the year, but it wasn't. It was all late, and we've had a nice reversal this year, and you can kind of see that we're still lagging behind in those, especially the energy stocks, and those are the stocks that typically do the best late in the long-term cycle. And obviously, if I were to now go all the way, through the 2 years now into what we're seeing here in 2019, so you can see 2 years worth of decline, or 2 years worth of underperformance on energy, still down 14% since in the past 2 calendar years, with technology now being up 40%, the S&P up 20%. But you can see materials too. So these two laggards over the past couple of years, you expect now to start to make their way back to the upside, whereas these big winners, you would start to see some of their gains slow down a little bit. Interestingly enough, for the 2-year period, look how strong utilities and real estate were, both up 20% themselves for the 2-year period here at that low. They're just now starting to get back some of their gains. And that's the other pattern. You see that reverse to the downside. In fact, you kind of go into the bullish year of 2017, which was a really strong bullish year, 2017. So here's the last 3 years, and the S&P 500 up 44% in that 3-year period. Technology, discretionary, healthcare being the best performers. Look at energy down 17% in what has been a strong 3-year period. Materials also lagging, about halfway behind, and then there's your real estate and staples, your other safety trades, but also industrials lagging behind. So expect those to start to show some relative strength before we start to see any signs that we might be on a mature long-term trend. All right, so our trade idea of the day is in consumer discretionary space, specifically on Disney. Disney had been kind of going sideways. It's on a big bullish run going into a couple major releases over the past month or so from their movie studios, as well as their monthly here in November, their Disney Plus service. So big move higher coming off of that in anticipation. And now you can see we had some light pink shading and a yellow line going into the last couple of days, going into expiration. And then today we kind of broke out in the wrong direction to the downside, to the point where the intermediate line is crossing below the market sentiment line, and you got short-term sentiment down at the bottom. You also see too, when you look at the two-line versions of these three green arrow charts, the 8 and 17 day are also crossing below. After having converged, they're crossing below their moving average. When you look at the Bollinger Bands here for Disney, you can see we've fallen below this point, this volume node, working our way down towards 140, where the next volume node is, working through a little bit of a volume gap here, which is very easy for it to do. We've been so bullish for so long. The negative directional index has been so subdued, so pushed down so low, was finally crossing above 25. And the positive, which has been up for so long, got up above 40, is now falling below 25. So similar to what we see here, what we saw. Now we bounced off of that, a little bit of a different scenario, and you can also see too the other factor that the other charting factor I wanted to bring up was the seasonality of here, let's go to a 20-year chart of Disney, this time of year for Disney. Let me show this as a percentage. You can see now this is the time of year where we kind of do show some weakness going into, you don't really see, for some odd reason it's clipping off the end here, going into really the end of January. This is a time of year where it starts to come down again. At least its gains are stopped, and we start working our way back down, not significantly down, but this staying down into January weakness. So if you take a look too at the Ichimoku cloud for Disney, we have been on a strong bullish trend. We have dropped below the blue line here. We're still above the cloud, so we've got some room to go down before we hit the cloud for support. The green lines also cross below the blue as the trend has gone, not just on the daily chart, but also on the weekly chart. There's no more bullish trend. We're back into a noisy level there. And then finally, taking a look at the long-term charts here, we've got a significant divergence forming on this lower high with higher highs, leading ourselves into a period where we might drop down below or start testing the 50-day moving average and potentially working our way towards the 200-day moving average, at least towards that low point at 130, which is the low in between these two divergent high points. So with that being said, it opens up a possibility to add some negative delta, some relatively small negative delta to our portfolio. We'll go out to the January options, which are only 25 days away, and we can sell the 148 and buy the 150 option, try to get 47 cents out of it. That's a 30% return on risk. And as long as we stay below this volume node, which is right around 148, then we maintain the maximum reward. And if it continues to go towards 140, then if we can hit 140 here, we'll hit and do it relatively quickly. We can get 50% or more of maximum gain and take it and move on to another trade. All right, that wraps us up for today. As always, thank you for watching. You've heard from me now. Now I want to hear from you over this break. Use that link popping out in the top right corner of your screen. If you have any questions about anything we've covered in these videos recently, let me know, or any comments for that matter, including tonight's video. If you have anything we didn't cover in these videos but you want my take on related to this kind of market outlook topic, then open up a new thread in the forum and reply to other people's threads, and let's keep this conversation going. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video below. Follow me on Twitter for more content in between these videos from day to day. Join our Market Outlook community that we've created at marketscholars.com, as well as the Facebook group we've created. Have a very, very Merry Christmas and a Happy New Year, everybody. Happy holidays to you and to your families. And I hope you all enjoy this next week and look for us to be back on with you after the new year in 2020. Thank you again for such a great 2019, and we look forward to an even better next year. So thanks again, everybody, for watching. Thanks for being a part of our community, and we'll see you all next time.